We used to think global economic shocks were all about the price of things.
Right.
Like a pipeline gets shut down or a port gets blocked, and we instantly look at the ticker.
Just to see how much the price jumped, yeah.
Exactly. But right now, across the entire global economy, we are frantically repricing something entirely different. We aren't pricing the physical disruption anymore.
No.
We are repricing time.
It's a massive structural shift in how the global system operates. We are moving from a world focused on price tags to a world that is completely ruled by the calendar.
Welcome to today's deep dive. We have an incredible stack of sources to go through for you today.
Really good stuff today.
Yeah, we've got Reuters reporting on global shipping bottlenecks, the latest Bureau of Labor Statistics inflation data, straight through to official funding releases from the European Commission.
Right.
And our mission today is to extract a hidden pattern running through all of these systems. We're going to look at 3 distinct clocks that are ticking right now in the global economy.
And show you how they dictate everything, really.
Yeah, from your grocery bill to international security.
What's fascinating here is the underlying mechanics of these shocks. When a physical choke point hits a supply chain, it doesn't just create a shipping delay.
Right.
It instantly becomes a financial constraint. To understand the modern economy, you have to stop looking at the headline prices. You have to start looking at the engineering schedules.
The data release calendars.
Exactly, the financing timelines.
So let's jump right into the first clock. Imagine this scenario. A supplier responsible for a massive chunk of the global supply of liquefied natural gas LNG suddenly goes offline.
Okay.
The instinct for anyone watching the market is to panic about the exact day the shipment stops.
Sure, yeah.
But the most important factor isn't the day it stops, it's the exact day it can restart.
Right.
And that return date is not some political decision that can be negotiated over a fancy dinner. It's a strict, rigid engineering schedule.
It really is.
So what are the sources actually telling us about this right now?
Well, we're seeing this exact scenario play out in real time. According to the Reuters reporting we have today, Qatar Energy has declared force majeure on several of its LNG shipments.
Due to the severe disruptions in the Strait of Hormuz.
Correct. Because the transport ships cannot safely move through that corridor, the actual liquefaction operations back at the facilities have halted.
Let's translate that for a second for you listening. Force majeure is a term that gets thrown around a lot in financial media.
Oh, constantly.
But in practice, that means they are pulling the legal emergency ripcord, right?
Yeah, pretty much.
They're telling buyers, look, there's an unavoidable crisis, an act of God, and we are legally voiding our obligation to deliver your gas on time.
That is essentially it. They are legally stopping the clock on their contracts. And just to put the scale of this into perspective, Qatar accounts for roughly 20% of the entire world's LNG exports.
20%.
20%. When a fifth of a critical global energy source just stops, the timeline to get it back online is the only thing that matters.
And the sources are telling Reuters it'll take at least a month to return to normal production volumes once the shipping lanes actually clear.
Right.
A month feels like a lifetime in energy markets. I mean, why does it take so long? If the ships start moving again on a Tuesday, why can't they just turn the gas back on by Wednesday?
Because you cannot just flip a switch on a massive cryogenic facility.
Right.
These are plants that cool natural gas down to minus 260 degrees Fahrenheit just to turn it into a liquid. That month-long timeline is broken down into very rigid engineering realities.
It's not just twisting a valve.
Not at all. You have an initial 2-week window just to make the safety and technical decisions required to even initiate a restart.
Wow. 2 weeks just to decide it's safe to start trying.
Exactly. Then once you actually begin the restart protocol, you have another 2 weeks just to ramp the pressure and the temperature back up to full output safely.
Okay, let's break this down. If the plant is shut down for a month, but the gas is still coming out of the ground,
right,
where does it go?
It doesn't have anywhere to go. And that is the terrifying bottleneck here. Reuters reports that the Roslaffen storage facility, which handles this output, has a capacity of about 1.88 million cubic meters.
Okay, to someone outside the energy industry, 1.88 million cubic meters sounds like an absolute ocean of storage.
It sounds massive, but in the context of global energy flows, it's essentially a thimble.
A thimble?
Yeah, at full production capacity, that entire storage facility fills up in just 4 days.
4 days?
4 days. So if the ships aren't arriving to take the gas away, the system hits a hard physical stop almost immediately.
It's a cascading failure driven by a lack of empty thermoses.
That's a great way to put it.
If you don't have an empty thermos to put the freezing liquid into, you have to shut off the entire factory. Storage becomes the ultimate binding constraint.
And while that facility is sitting there totally full and unable to produce more, the geopolitical tension just goes through the roof.
Oh, absolutely.
The industry is currently tracking a massive spike in basin competition.
Basin competition, meaning buyers from the Atlantic Basin, like Europe,
Right.
and buyers from the Pacific Basin, like Japan and South Korea, are suddenly realizing 20% of their global supply is trapped.
Precisely. They are effectively fighting over scraps. They're aggressively outbidding each other for whatever unassigned floating cargoes are currently out on the water.
And we can't look to the usual backups to bail the system out, can we?
No. The Reuters data explicitly notes that the United States, which is a major LNG exporter, is basically operating at maximum output right now.
They're maxed out.
Maxed out. Furthermore, a massive chunk of that U.S. output is already legally committed under strict, long-term contracts to specific buyers.
So there's no slack in the system.
There is virtually zero swing supply. There is no extra capacity waiting in the wings to flood the market with emergency gas.
Which brings to mind a really important historical parallel.
Oh, the 1970s.
Exactly. If you look back at the massive oil crises of the 1970s, markets have a very specific psychological reaction. On day one of the shock, everyone panics about the price per barrel. They bid up the physical molecule.
Right.
But the true systemic economic crisis didn't hit until the calendar extended beyond the existing storage reserves.
That is the crucial lesson from the 70s. The initial price shock hurts, but the economy can usually absorb a brief spike. The real damage occurs when the physical tanks run completely dry, the pipeline networks lose pressure, and the restart schedule is still weeks away.
Because then you have physical shortages, not just expensive energy.
Exactly. That is when factories have to shut down entirely because they simply cannot get power at any price.
Here's where it gets really interesting. Everyone talks about LNG in the media like it's just this fluid global commodity that smoothly finds a price on an open exchange.
Right.
But when your storage fills up in 4 days, and it takes an absolute minimum of 4 weeks to restart operations, and all your backup cargoes are locked into legal contracts,
It changes everything.
this is no longer a price discovery problem. It is a scheduling problem. Markets aren't pricing the molecule right now. They are pricing the clock.
That is the perfect way to frame it. So for you trying to understand where this energy shock goes next, you need to ignore the daily noise of the ticker.
And watch what?
Watch 3 specific variables. First, watch the official restart guidance from the operators. Look for confirmed sequencing, not just vague political promises.
Real engineering timelines.
Second, watch the dislocation between spot prices, which is the cost for immediate emergency delivery, and the long-term contracts.
Why does that gap matter?
If spot prices are spiking wildly while long-term benchmarks barely move, the market is panicking over immediate time, not long-term value.
Got it. What about the ships themselves? If they can't go through the Strait of Hormuz, they have to go around, right?
That is the third variable, and it is the silent multiplier here. Watch the LNG freight and shipping reroute costs.
The detour.
Yeah. If these massive tankers have to take a 3-week detour around the Cape of Good Hope, that adds nearly a month to their round-trip journey.
Which means they can't make as many trips.
It essentially removes those ships from the available global fleet for an entire month. Shipping cost is the multiplier that makes the time constraint so much worse.
So when shipping costs explode because a gas tanker takes a 3-week detour, who actually pays for that lost time?
We all do. It gets passed down the chain.
And that is exactly what's showing up in the second system we're tracking today. When energy costs spike due to these physical scheduling constraints, it eventually bleeds directly into the broader economy.
It always does.
Which brings us to the inflation data clock. If you turn on a financial news network, Wall Street treats the Consumer Price Index, the CPI, like a sports score.
Did we beat the estimate? Did we miss it? Time trade.
Exactly. But policymakers, the central bankers who actually control interest rates, they treat the CPI like a schedule. It is a gate they must pass through before they can make their next move.
And the data we have from the Bureau of Labor Statistics for January 2026 is incredibly telling on this front.
Give us the numbers.
The headline, CPI rose 0.2% month over month. That puts it at 2.4% year over year.
Okay, so on the surface, to a casual observer, That sounds relatively benign.
It does.
It sounds like inflation is cooling off.
But the core CPI, which strips out the highly volatile food and energy elements to show the underlying trend, that stubbornly rose 0.3% month over month.
Wait, if it strips out energy, why does a 0.3% monthly bump matter so much? It sounds tiny.
Because it compounds. Mathematically, a consistent 0.3% monthly increase does not reconcile with a smooth return to the central bank's target of 2% annualized inflation.
Adds up too fast.
It means the baseline temperature of the economy is still running hot, and the clock is ticking loudly on the next Brit. The BLS drops the February 2026 CPI release on March 11th at exactly 8:30 a.m. Eastern Time.
And this ties right back to our LNG discussion, doesn't it?
Yeah.
Energy shocks transmit through the economy in a very delayed, uneven way.
Very delayed.
When the price of moving things spikes because of those shipping detours, it hits producer prices and industrial transportation costs first.
Right.
Then, a few months later, it bleeds into the service sector. And finally, if it lasts long enough, it warps consumer expectations.
Which is the danger zone.
You start demanding a raise because everything at the store is more expensive, which drives inflation even higher. It is a slow-moving wave.
If we connect this to the bigger picture, it completely shifts the paradigm of the mainstream economic debate.
How so?
Right now, the consensus argument on television is binary. Is inflation finally solved, or is it coming back?
The soft landing versus hard landing debate.
Exactly. But the real regime question for policymakers is far more complex. What if inflation settles at a lower number, say 2.5 or 3%, but remains fundamentally unstable?
Unstable inflation, meaning it might look fine one month and then jump wildly the next because of an unpredictable supply shock.
Exactly. In a world of periodic, unpredictable supply shocks, like a sudden force majeure shutting down 20% of global LNG central banks are trapped.
Yeah, they're cornered.
They are forced to choose between two terrible options. They can either chase every single volatile data print with rapid, chaotic interest rate changes,
Which spooks the markets.
or they can just throw up their hands, tolerate the volatility, and risk destroying their long-term credibility with the public.
So what does this all mean for you listening?
Yeah.
When that alarm goes off on March 11 at 8:30 a.m., here is exactly what you need to look for to cut through the noise.
Don't just look at the headline number.
Right. Do not just look at the headline number flashing on the screen. Look at the composition of the print. You need to separate out the sticky shelter costs, the services excluding shelter, and the direct, delayed pass-through costs of those energy bottlenecks we just talked about.
And pay very close attention to how the bond market reacts to those specific numbers. You want to watch the relationship between break-in rates and real yields.
Let's do a quick translation on that because bond market jargon can get dense quickly. Break that down for us.
Absolutely. Think of break-in rates as the bond market placing a bet on what inflation will be over the next few years.
Okay.
If break-ins shoot up, investors are simply betting that inflation will stay high. That is a normal reaction to bad data.
And real yields?
Real yields represent the actual return an investor demands on government debt after adjusting for that inflation. If real yields start moving aggressively, that is a much deeper problem.
Why?
Because that means the market is losing faith in the central bank's ability to control the economy at all.
CPI is essentially the economy's metronome. And right now, regardless of what the headline says, that metronome is beating just a little too fast and a little too erratically for comfort.
It's setting a tempo that the rest of the financial system is struggling to dance to. And when central banks are trapped by this volatile metronome, governments have to step in.
They try to use their massive balance sheets to actually buy time and buy coordination.
Exactly.
Okay, let's unpack this. We are looking at the European defense cash flow clock. When you read a headline that says a European government is announcing 800 billion euros for defense, the media immediately paints a dramatic picture.
They show B-roll of tanks rolling off assembly lines.
Drones taking flight, stockpiles of artillery shells. But the real story in the source material isn't about the physical procurement of weapons. It's entirely about the financing structure behind it.
That is the hidden mechanism here. It's about who gets paid, when they get paid, at what interest rate, and with what level of cross-border coordination.
The primary source we are tracking for this is the European Commission's recent implementation of the SAFE program.
Yes.
SAFE stands for Security Action for Europe. What are they actually doing with this program?
The Commission's documents outline a 150 billion euro envelope dedicated entirely to joint procurement.
Joint procurement.
And the specific mechanism they are using is critical. They are providing low-cost, long-term loans directly to member states, rather than just giving them cash grants from a central budget.
But the clock is already ticking on this, right?
No.
It isn't just a theoretical fund.
Not at all. The Commission just officially approved a €38 billion first wave of these national defense investment plans for 8 specific member states.
And the timeline is tight.
Incredibly tight. The European Council now has exactly 4 weeks to adopt the implementing decisions for this first wave.
Let me stop you there. Implementing decisions. That sounds like classic European bureaucratic paperwork. What does that actually mean for the money?
It is the final bureaucratic rubber stamp that actually unlocks the vault. If the Council adopts those decisions within the 4-week window, the first actual cash payments are expected to hit the accounts of defense contractors in March 2026.
Why does this specific structure, using low-cost loans for joint procurement, matter so much? Why don't the countries just buy the tanks themselves?
Because joint procurement is essentially a coordination technology.
A coordination technology.
Historically, Europe's defense industry has been wildly fragmented. You have multiple countries buying completely different radar systems, different ammunition calibers on completely different timelines.
It's a mess for the manufacturers.
The suppliers are flying blind. They don't know what to build or when to build it because they don't have a unified demand signal.
And SAFE changes that.
SAFE standardizes that demand across the continent. It gives the defense suppliers the predictable, long-term guarantees they desperately need to justify expanding their factories.
And the choice to use loans instead of direct spending.
Financing terms dictate behavior. Using low-cost loans backed by the European Commission allows these member states to dramatically accelerate their defense spending today without inflicting immediate, crushing pain on their current domestic budgets.
So they get the cash flow right now to start building.
Exactly. But the trade-off is massive. They are locking in future financial constraints. They are putting this on a long-term credit card.
Here is the sting in the tail of this whole program. The consensus view, what you hear from politicians making speeches and what you read in the op-eds frames Europe's defense push purely as rearmament.
Right.
It's framed as a sudden awakening of military-industrial might. But financially speaking, if you look at the actual mechanics of the SAFE program, it is essentially a massive project finance scaffolding.
It looks much more like funding a massive multi-decade global infrastructure project than a traditional year-to-year military budget.
Right. It is designed from the ground up to take political intent, which is cheap, volatile, and often fleeting, and turn it into rock-solid cash flow certainty.
Yeah.
And cash flow certainty changes the behavior of industrial manufacturers far faster and far more effectively than any political speech ever could. A CEO cannot take a political speech to a commercial bank to get a billion-dollar loan to build a new munitions plant.
The bank will laugh them out of the room.
But they can absolutely take a guaranteed 10-year joint procurement contract backed by a low-cost European Commission loan.
This changes everything about how you track the story over the next few months. You need to watch where the money actually flows, not just where the politicians say it will flow.
Follow cash.
Watch which specific categories get prioritized in these implementing decisions. Is the money going to air defense, artillery ammunition, drones, secure communications?
And crucially, watch to see if those requests actually converge across the different countries.
Yes, or if they stubbornly fall back into their fragmented, individualized buying habits.
And you also have to watch the physical supplier capacity.
Right, because that's another clock.
Exactly.
Yeah.
When this €38 billion wave hits the accounts in March 2026, does the physical output of defense goods actually rise? Do we see more drones coming off the line?
Or do the prices of those goods simply inflate faster than the quantities produced?
Right, because the factories simply cannot build things fast enough to absorb all that cash.
That is the ultimate test of the SAFE program. It is Europe attempting to use its massive balance sheet to buy coordination. Because right now, across every sector we've discussed, coordination is the ultimate scarce resource in the global system.
So let's bring all of these threads together. We have looked at 3 distinct clocks today. The LNG restart clock ticking in the Middle East, the inflation data clock ticking toward March 11th, and the European defense cash flow clock racing toward its first payouts.
On the surface, energy, inflation stats, and defense loans seem completely disconnected.
But they share one unified, undeniable pattern. Physical systems, whether it's the strict capacity limit of a gas storage tank, the slow, grinding crawl of a shipping delay through the service sector, Or the physical time it takes to build a new drone factory. Those physical systems set the rigid timelines.
And the world of finance simply translates those physical timelines into prices.
Understanding these clocks fundamentally changes how you should read the news. When you see a headline about a global crisis, you stop reacting to the immediate price jump.
You stop panicking over the day the disruption starts.
Instead, you start looking for the bottlenecks. You look for the storage capacities, the data release schedules, and the financing timelines driving the recovery.
This raises an important question, and it's something I want you to really mull over before our next deep dive. We've seen today that coordination and time are the ultimate scarce resources in our modern economy. But what happens if two of these massive clocks collide?
Think about the mechanics we just laid out.
Exactly. What if that extended multi-week LNG outage constraint, combined with a massive multiplier effect from shipping costs, hits the global economy at the exact moment a volatile, stubborn inflation print forces central banks into a corner on interest rates?
Wow.
Can a delicate project finance scaffold like Europe's SAFE program, which relies entirely on the assumption of low-cost, predictable loans, survive that kind of simultaneous compounding pressure? If time gets too expensive, the scaffolding might not hold.
That is a massive question, and it perfectly sets the stage for where we are going next. Tomorrow, we are mapping the second-order balance sheet effects of everything we discussed today.
We are going to show you exactly where these specific shocks are going to show up first.
Looking closely at utilities, chemical manufacturing, food production, and freight logistics. We will break down the exact indicators that reveal whether the global system is successfully absorbing the shock or if it is actively breaking under the pressure.
It is going to be a fascinating look at the ripple effects of the calendar.
You won't want to miss it. Thank you so much for joining us for this deep dive. Keep watching the clocks, keep questioning the headlines, and we will see you tomorrow.